we at Goldman Sachs, early on said this would be a second half sharp contraction and a very significant bounce back in the second half, and we're starting to see evidence that's true. Annualized, the Goldman Sachs view is that this year we're going to see growth, or 2020 growth, be down about 4.4%, but in 2021 we'll see that go back up to 5.8%. I just saw a comment made by one of the clips there talk about when do we get back to real GDP, back to where it was in 2019 before COVID. Well, in fact, that probably happens sometime in mid-2021. So, things actually are getting better. Yeah, we had a very sharp recovery, much sharper than we thought it would be, but it was largely due to pent-up demand. And despite the fact that we've had these outbreaks, particularly down through Florida, Texas, and California, large economic drivers in the U.S. Basically, we actually gone backwards, but growth has definitely slowed. So the path for the market is much of the same. It grinds higher as investors continue to, find very little in the form of yield in less risky assets. And I think they feel that the prospects for the general recovery is guardedly optimistic, and they will continue to lean into equities. And that's why you see we're relatively close to an S&P high.
Right. Mike, how comfortable are you with the valuations for the markets right now? I mean, what we saw from the earnings season thus far, that earnings for this quarter or the quarter gone by have looked less bad than anticipated. And so adjusting for earnings, where do you think valuations justify themselves for the market?
Well, that's really interesting. It's a loaded question, because if you look at what we're trading on based on 12-month forward earnings, we're trading somewhere in like mid-24, 25 times next year's earnings. And that's the nosebleed territory, right? Before COVID, we were worried about valuations being too high. We had obviously a much better expectation for earnings this year, and we were at 19 times. But what you really have to think about in this environment is that interest rates are so low, it's changed the dynamic dramatically with regards to the relative value of equities versus relative value of owning fixed income. As yields get lower, it becomes increasingly attractive to buy equities. So this is not a new theme. This is a theme that's been going on for years. It's been a central thesis in our model working group as to why we've actually had a long, many-year bias towards being overweight U.S. domestic equities, and this probably can continue. Fixed income, as long as yields are low, there's just a lot of cash trying to find a home and equities. With the prospects for the guarded optimism about getting control of the virus, a lessening impact on the global economy, and the green shoots that you're starting to see, the certain resiliency, you hope and we think that you'll be in a far better place 12 months from now.